Hello again, I'm Andrew Drane from Ray White's Seven Hills, and welcome to my final market update for 2022. Well, the news this month is good and bad. Home values have experienced the 7th consecutive month of decline. On the other hand, the rate of decline has decreased. November experienced the smallest monthly drop since June. Overall, this is now around $53,400 below the peak value, which recorded last April. The brakes on this downward trend have mainly been at work in Sydney and Melbourne, whose rate of decline is a good 1 percentage point lower this month. For Sydney, this means the rate of falling values is now 1.3% compared to the previous rate of 2.3%. In fact, the pace of decline has decelerated across the board in Australia. Some of the figures for Sydney look rather dramatic. It's the only city where values have fallen by over 10% from their peak. But then values peaked by 27.7% by January this year, so there's still a significant amount of buffer. Melbourne, on the other hand, might fall to pre-COVID levels in the first quarter next year, mainly because their upswing was always a little weaker than Sydney's. Let's break down some of the statistics around how the increases have affected the bottom line of mortgage holders. For those that had a mortgage of say $1 million when the official cash rate was at 0.1%, they're now paying $1,600 more per month than they were in May last year. A $750,000 mortgage will now cost you a further $1,337 per month. Or even simpler, at a $1 million mortgage, every 0.25% rate rise will cost you an additional $150 per month. Or how about this? If your mortgage is up around $2 million, you're now paying a whopping $3,838 per month in additional repayments. These figures are based on the November cash rate rise, and now we have to factor in another 0.25% rise in the official cash rate in December. The year 2023 will be the big test. We might see the rate of decline accelerate again, especially if interest rate hikes continue at their current rate. At the spate of record low fixed interest rates that happened in 2021 begin to pass their use-by dates, we might see loan serviceability tested. Mortgage arrears rates are still relatively low, but we can, unfortunately, expect them to rise given higher interest rates added to inflation. However, that buffer is still there due to a history of higher than usual mortgage repayments, which means borrowers have enough in their offset redraw accounts to cover another rate hike this time. Household savings are also cushioning the effect of the rises. The news out of Perth and Darwin is relatively good. They actually pushed to a 0.2% higher rate over the month of November thanks to high levels of housing affordability. In terms of new home listings, the news is lukewarm. There's a lower than normal number of new listings, 30.8% lower than this time last year. But this goes some way towards lessening the impact of higher interest rates and waning consumer sentiment. Now to unit housing. The market continues to be relatively resilient. The drop in capital city unit value still lags behind housing values. Thankfully, this means unit prices are still more affordable overall. Now, in terms of rental markets, they still remain fairly tight. In most regions, vacancy rates are around 1%. This is the lowest for about a decade. The low supply is due to a number of factors, the main one being high demand due to strong migration levels. The diminution of rental growth in capital cities is still mainly concentrated on house rents rather than units. The more affordable options are still in the high density sector. Good news for those who enjoy the hustle and bustle of the high density areas, not so good for those who enjoy space and a yard for the kids and pets. The other trend related to rental affordability is higher occupancy in single homes as tenants try to spread the cost. So a summary, look to interest rates if you want to keep an eye on market conditions. I think interest rate might peak in the first quarter of 2023, but I must say, in today's market, this is not entirely predictable. An oversupply of homes available would normally mean the downturn is about to accelerate, but this is not the case. Inventory is actually low and offsetting the slump in housing demand. For the young couples or anyone looking to enter the market, entry-level barriers to home ownership have actually eased according to the metrics. It takes less time than it did to save a 20% deposit, and median residence value in relation to income have reduced from 8.4% in the March quarter to 7.9% in the third quarter. This is good news for the first home timers. Okay, that's it for this month. We can expect a disruption to the selling and buying process over the festive season, of course, but have a great Christmas, Happy New Year, and I hope to see you back safe and sound in the month. I'm Andrew Drane, Principal of Ray White Seven Hills, and I'll see you in 2023.